Somewhere in America right now, there is a person sitting in front of a computer screen who has just typed the words financial statements into a search engine. They clicked on the first result. They saw a page of numbers organized into rows and columns with labels they did not recognize, and within about 45 seconds they closed the tab. They told themselves they were not a numbers person. They told themselves that reading financial statements was something accountants and analysts did, not ordinary people, and they went back to doing what most investors do, which is reading articles about stocks and watching videos about which companies someone else thinks are going to go up. And that decision, that small quiet retreat from one page of numbers, cost them more money than they will ever be able to calculate. Because here is the truth about financial statements that nobody in the financial media has any incentive to tell you. They are not complicated. They are not designed for specialists. They are not written in a secret language that requires years of training to decode. They are simply a structured way of answering three completely ordinary questions about a business. Three questions that any sensible person would ask before buying a business on their street. And once you understand what those three questions are, you will never look at a financial statement the same way again. Today, I am going to teach you how to read financial statements. Not at the level of a chartered accountant, not at the level of a forensic analyst, but at the level of an intelligent investor, which is all you ever need to be, and which is something you can genuinely achieve by the end of this video. Why I made this the foundation of everything I taught. When I began teaching at Columbia University in the 1930s, I had a choice about where to start. I could have started with market theory. I could have started with portfolio construction. I could have started with the psychology of investing, which I also believed was enormously important. I started with financial statements. Every student who sat in my classroom learned to read a balance sheet before they learned anything else. And the reason was simple. You cannot know what a business is worth without understanding what it owns, what it owes, and what it earns. Everything else in investing is built on top of those three foundations. Intrinsic value is built on them. The margin of safety is built on them. The ability to distinguish between a business that is genuinely healthy and one that merely looks healthy from the outside is built on them. My student Warren Buffett has said that when he discovered my work and began reading financial statements seriously, it was like having a light switched on in a previously dark room. That light is what I am going to switch on for you today. There are three financial statements that every public company produces, and every investor must understand: the income statement, the balance sheet, and the cash flow statement. Each one answers a different question. Each one tells you something the others cannot, and together they give you a complete picture of the financial reality of any business you are considering. Let us take them one at a time. The income statement. What does this business actually earn? The income statement answers the first and most fundamental question: is this business making money? It covers a specific period of time, usually 1 year or 1 quarter, and it shows you in sequence every major financial event that happened to the business during that time. It starts at the top. With revenue, revenue is the total amount of money that came in through the door. It is every dollar the business collected from its customers before paying for anything at all. Revenue sounds important, and it is. But I want you to remember something critical. A business can have enormous revenue and still be destroying money for its owners. So revenue is only the starting point. It is not the destination. The next line below, revenue is cost of goods sold or cost of revenue, depending on the industry. This is the direct cost of producing whatever the business sells. If a company sells coffee, the cost of the beans, the cups, and the labor to make each cup all goes here. Subtract this from revenue, and you get gross profit. Gross profit tells you how much money the business keeps from each dollar of sales before paying its overhead. And this number tells you something very important about the fundamental economics of the business. A company with high gross profit margins has pricing power. It charges more than its direct costs by a wide margin, and that usually means customers genuinely value what it sells, and competitors cannot easily undercut it. A company with thin gross profit margins is in a much more difficult position. It must sell enormous volumes just to survive, and any cost increase anywhere in its supply chain threatens its existence below gross profit. You see operating expenses. These are the costs of running the business that are not directly tied to producing each individual unit. The salaries of the management team, the rent of the offices, the marketing budget, the research and development spending. Subtract operating expenses from gross profit, and you get operating profit, or EBIT, which stands for earnings before interest and taxes. Operating profit is one of my favorite numbers because it tells you how profitable this business is from its actual operations before the effects of how it chose to finance itself. Interest expense belongs to financing decisions, not operating ones, and taxes vary by jurisdiction and structure. So operating profit strips those away and shows you the core engine of the business below operating profit. You see interest expense. This is what the company pays on its debt, and this number matters enormously to me. A company with very high interest expenses relative to its operating profit is a fragile company. It has borrowed heavily to finance its operations, and if business softens even slightly, it may find it difficult to service its debts. This is how otherwise solid businesses fail, not from the business itself declining, but from the weight of the debt they took on during better times. After interest expense, you subtract taxes and you arrive at net income. Net income is the bottom line, the profit that belongs to the owners of the business after everyone else has been paid. But I want to give you one warning about net income right now. Net income is the number that management teams and financial journalists focus on most heavily, and it is also the number that is most easily manipulated through legitimate accounting choices. A company can choose accounting methods that make net income look higher than the underlying cash reality of the business. This is why the income statement alone is never enough, which is why we need the third statement. But first, let us understand the second one, the balance sheet. What does this business own, and what does it owe? If the income statement is a movie showing you what happened to the business over a period of time, the balance sheet is a photograph showing you exactly what the business looks like on one specific day. It is built on a single equation that has governed accounting for 500 years. Assets equal liabilities plus shareholders. Equity. Let me explain each piece. Assets are everything the business owns or is owed. Current assets are things that can be converted into cash within 1 year. Cash itself, obviously, but also accounts receivable, which is money customers owe the business for things they have already received, and inventory, which is the goods the business has produced or purchased and not yet sold. Non-current assets are longer-term assets, property, buildings, manufacturing equipment, patents, intellectual property, and investments in other businesses. The total of all these is what the business has. Liabilities are everything the business owes to others. Current liabilities are debts and obligations due within 1 year. Accounts payable, which is money the business owes to its suppliers, short-term debt and accrued expenses. Non-current liabilities are longer-term obligations, primarily long-term debt. The difference between total assets and total liabilities is shareholders' equity. This is what belongs to the owners of the business after everything owed to everyone else has been accounted for. Now here's what I look for on a balance sheet and what has served me well for my entire career. First, I look at the relationship between current assets and current liabilities. This is called the current ratio, and it tells me whether the business can pay its short-term bills if current assets are comfortably larger than current liabilities. The business has breathing room. If current liabilities are approaching or exceeding current assets, The business is in a precarious position, and one bad quarter could create a genuine crisis. Second, I look at the total debt relative to the total equity. A business that has borrowed heavily relative to what its owners have put in is taking on significant financial risk. In good times, leverage amplifies returns, but in difficult times it amplifies losses, and it removes the flexibility that every business needs to navigate unexpected challenges. Third, I look at the trend of shareholders' equity over time. Is it growing year after year? That suggests the business is consistently profitable and reinvesting those profits wisely. Is it shrinking? That suggests the business is either losing money or paying out more than it earns. And in either case, I want to understand exactly why the balance sheet is where financial strength or financial fragility lives. The income statement can look beautiful for several years, while the balance sheet quietly deteriorates. And when it deteriorates far enough, the beautiful income statement becomes irrelevant because the business cannot survive long enough to earn the profits. It is projecting the cash flow statement. Is the money real? The cash flow statement is the most honest of the three statements, and it is the one that most beginning investors ignore completely. This is a serious mistake. The cash flow statement answers the single most important question about any business: is the money real? Let me explain what I mean by that. Accounting rules allow companies to recognize revenue before they actually receive the cash. They can recognize profits from deals that have not fully settled. They can defer certain costs in ways that make current earnings look better than the underlying cash reality. The cash flow statement strips all of that away. It shows you actual cash that actually came in, and actual cash that actually went out during the period. There are three sections operating cash flow. This is cash generated by the actual operations of the business, selling its products or services, collecting from customers, paying its suppliers and employees. If a business is genuinely profitable, its operating cash flow should be positive, and it should roughly track net income over time. If a business consistently reports strong net income but weak or negative operating cash flow, that is one of the most serious warning signs. I know it means the accounting profits are not translating into real money in the bank, and that demands very careful investigation. Investing cash flow. This section shows cash spent on long-term investments, primarily capital expenditures, which is money spent on property, equipment, and other long-lived assets. This number is almost always negative for growing businesses, and that is fine. Investing in the future costs money, but I pay close attention to whether the capital expenditure is building genuine long-term value or simply maintaining aging infrastructure that must be replaced just to keep the business running at its current level. Financing cash flow. This shows cash flowing between the business and its financial stakeholders, money raised from issuing new debt or new shares, and money paid out as dividends or used to buy back shares. The number I care most about in the entire cash flow statement is what is called free cash flow. Free cash flow is simply operating cash flow minus capital expenditure. It represents the actual cash the business produces after maintaining and building its operational base that is available to do whatever the business and its owners want with it. Pay dividends, reduce debt, make acquisitions, return cash to shareholders. A business that generates strong and growing free cash flow over many years is a fundamentally healthy business, regardless of what the accounting line items look like. A business that consistently consumes more cash than it produces is dependent on the goodwill of lenders and investors to survive, and that goodwill is never permanent. How to read them together. Now let me give you the single most powerful thing you can do with these three statements together. When you are evaluating any business for the first time, I want you to do one simple exercise. Pull up 5 years of financial statements for that business and look for these things in sequence. Does revenue grow consistently over the 5 years? If revenue is declining or erratic, understand why. Before going further, do gross margins stay stable or improve? If gross margins are shrinking year after year, the business is losing its pricing power or facing rising costs that it cannot pass on to customers. Both are serious problems. Is operating profit growing in line with revenue or faster? If revenue is growing, but operating profit is not growing proportionally, the business is scaling but not becoming more profitable. And that is a warning. Is net income growing? And does it roughly track operating cash flow? If the gap between net income and operating cash flow is consistently large in net income's favor, investigate the accounting assumptions behind it. Does free cash flow grow over the 5-year period? This is the ultimate test. A business that grows its free cash flow consistently over 5 years is a business that is genuinely creating value for its owners. And finally, look at the balance sheet. Trend is debt growing faster than equity. If it is, the business may be borrowing to fund profits that its operations cannot genuinely produce, and that always ends badly. This 5-year sweep takes about 20 minutes with practice, and it will tell you more about the fundamental health of any business than 100 articles about what the stock price is doing. The one number beginners ignore, that professionals never do. I want to spend a moment on one specific ratio that I have used throughout my career, and that most beginners have never heard of. It is called return on equity. Return on equity is calculated by dividing net income by shareholders' equity and expressing it as a percentage. It answers this question for every dollar the owners of this business have invested in it. How many cents does the business earn back each year? A business that consistently earns a return on equity of 15% or higher, without using excessive debt, is a genuinely excellent business. It is earning strong returns on the capital entrusted to it by its owners. And that consistency of return almost always reflects some form of competitive advantage that protects the business from easy imitation. A business with low or declining return on equity is a business that is struggling to earn adequate returns on the capital it has been given, and no amount of revenue growth will fix a fundamentally poor return on capital business over the long term. Warren Buffett has described return on equity as one of the most important single numbers he looks at when evaluating a business. And I taught him that: look for it, find it, track it over 5 years, and it will tell you more about the quality of a business than almost any other single figure. Your assignment here is what I want you to do before your very next investment decision. Go to any financial data website. There are several free ones, and look up any company you already own or are considering owning. Find these 5 numbers for each of the last 5 years. Revenue each year, operating profit each year, net income each year, operating cash flow each year, total debt each year. Write them in a simple table, 5 rows and 5 columns. Then ask yourself 3 questions. Is the trend going the right direction in most of these numbers? Is there a large and consistent gap between net income and operating cash flow that I need to investigate? Is the debt growing faster than the business? You do not need to be an accountant to answer these questions. You need to be honest and patient and willing to look at numbers that are freely available to anyone who chooses to look at them. That willingness to look at the actual financial reality of a business instead of the story being told about it is the single most important habit that separates an investor from a speculator. The speculator asks, what is this stock going to do? The investor asks, what is this business actually worth? And is the financial reality behind it healthy enough to justify that value? These 3 statements give you the financial reality. Everything else is noise. The bottom line, the income statement, tells you whether the business is making money and how the economics of its operations work. The balance sheet tells you whether the business is financially strong or financially fragile, and what the owners of the business actually have after all obligations are met. The cash flow statement tells you whether the profits are real, whether the cash is actually arriving, and whether the business is genuinely creating or destroying value for its owners together. They are not a wall of incomprehensible numbers. They are 3 answers to 3 simple questions. Is it earning? Is it solid? Is the money real? Ask those three questions every time with the patience to actually look at the numbers behind them, and you will be doing something that the vast majority of people who call themselves investors have never once done in their investing lives. You will be looking at the actual business. That is how the intelligent investor thinks. Thank you.